Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to talk about this company. Cummins is one of the companies that I've had in my portfolio for a long time. I'm up 21%, almost 22%, or 544 pounds, right? What I want to do today is just talk about, give you what the company does, give you some of the financials, and then tell you what I'm going to do moving forward. They've reported their earnings just last week, so this week, Monday. And as you can see here, their GAAP EPS was actually in line with what they were expected to report. And their revenue actually grew 32% year on year on. So from last year to this year, they grew that revenue 32%. So that's a beat of almost 600 million. The guidance was actually, the outlook was actually quite good moving forward. And that's why the stock went up a little bit and then it kind of went on the red because of everything else was going down on Monday, I think. So let me give you the overview of what the company does generally. So the company manufactures and distributes and services diesel and natural gas engines, electric and hybrid powertrains, and related components worldwide. It operates through 5 different segments. The first one is engine, distribution, components, power systems, and new power. So those are the 5 different sections. The company offers diesel and natural gas powered engines under the Cummins and other customer brands for heavy and medium duty trucks, including buses and so on, recreational vehicles, light duty, constructions, mining, marine, rail, oil and gas, defense, agriculture, you name it, this company is involved. What they do is also, so they create their own engines and their own brands and so on, and then sell it to other companies. They also work with other companies that like to create their basically engines. So for example, Ford, GM and so on will create their own cars, and this company will create the engine for them. But obviously that engine will have the name Ford and GM and so on. So that's something else they do. So they work with almost everybody, and they also have their own engines. And this is what I like about this company. It's not just gonna go out of business because they their own products are not selling. They are working with some of the biggest companies out there, and they are not only stuck in the days where they still basically used to make just the diesel engines. They are now trying to diversify away from that and have basically a newer technology. So they're reinvesting a lot of money into basically newer technologies to kind of keep up with the demand and so on. So what I want to show you today is just to give you an overview of what the company, where the company is financially, and then tell you moving forward what I'm planning to do. So if you want to learn more about the company, go to their website, their financial side of things, and you will learn more about the business. But like I already said to you, they work with so many different companies, and they even have basically power generators, let alone anything else, okay? They currently trading $246 per share. Obviously, they're in the industrial side of things. EPS is $13.42. Market cap of $36 billion. So they're not a huge company. And this is what I like about the almost kind of small cap companies, because no one else knows about it. And they're doing really well. I think they went down a bit in the last few weeks. But at one point with this company, I think I was up 800 or 900 pounds, whatever it was. They have a basically narrow economic mode, and beta is not as basically crazy as other companies out there, but it's a little bit high. Okay, PE is very low. Forward PE is actually quite low, but the 5-year average, when you look at the 5-year PE, is lower in basically than where it is. So this tells me the company may be a fair valued at the moment, possibly overvalued at the moment. Okay, because the PE for the industrials is right now 20. So cheaper than in basically relative to the overall sector, but more expensive than it has been in the last 5 years. Price to free cash flow is slightly higher. Okay, dividend yield of 2.5%, which is amazing. The latest increase was 8%. The 5-year growth rate is 7%. The annual payout, so this is how much they will pay you for holding one share of this business, $6.28. They have increased this dividend for 16 years in a row. The payout ratio is only 40%, which is very nice. And 98% dividend safety, according to Simply Safe Dividend, which is quite very, very good. Price to free cash flow, they have about, sorry, not free cash flow here. They've got $1 billion of free cash flow, which is very good. Price to free cash flow yield is basically about 6.6%, which is very high in comparison to basically what we were looking for. Profit margin is 7.3. Okay, that's a little bit low. Normally we look about 15. Operating margin is about 10, return on equity 22, and total return in the last 10 years is about 10%. Revenue growth of the last 5 years, the compounding annual growth for the last 5 years is about 6%. And current ratio, normally we're looking for anything above 1, and this is definitely above 1, which is quite good to see. Growth estimates for the next next year is 26%. So they're expecting these analysts in Yahoo Finance, they are expecting Yahoo Finance puts these things together, but the analysts are from different banks and so on, investment companies. So 26%, and then next 5 years we're expecting about 7% growth. So this type of business is actually quite nice. If it's growing even 7 and above percent is really, really good, but 26% is even better. So current price, we've already seen 246. The fair value for this company is $341, according to Simply Wall Street. And they are saying it's 28%, almost 25%, almost undervalued at the moment, which is quite good. Fair value for Morningstar is actually 256. And they're saying it's about 4% discount at the moment. And actually, I like this, okay? So that's roughly where I think the company is. And I was hoping that it will come back maybe down to at least the 10% range, and then I can start maybe nibbling again. I'll tell you exactly what I'm doing in a second. Target price from tip rank is about 256. And remember, this is for the 12 months price, so 256. So they kind of agree with Morningstar, if you like, okay? So 4 and something percent. Average price from Seeking Alpha is almost the same, but slightly higher, so about 2.45. I think this might be, I need to update that, I think. Let me just double check with what Yahoo Seeking Alpha is saying. So let's go here, let's go to ratings, and then go to Wall Street. It might be slightly different. So there we go. It's about 6%, and they've actually increased their price from 260. Okay, so yeah, just a little bit. It's not much actually. So it's about 4% if you look at it again. So it's about 6%, sorry, overall. That's what they were saying, right? It's a buy from them, as you can see here. Okay, so they are saying it's actually buy 3.56%. In terms of Sharia compliance side of things, in terms of business side of things, is absolutely fine. Interest-bearing debt, 22%. I'll talk about the debt levels in a second for this company. Interest-bearing securities, about 10%. And outstanding shares are declining, which is very, very good to see. Now, like I said, I want to talk about in terms of debt levels. So if I go to financials and go to balance sheet, and if scrolled all the way down here, what I'm looking for is total debt. Okay, and the reason I'm looking for the total debt is because it looks like this company's total debt is actually increasing year after year, which is basically a little bit worrying. So I'm hoping that in the next quarters they will actually start paying off, or start paying some of this debt off, because that's not great to see a company basically get into more debt. Because what happens is, if the market cap comes down, although right now we're looking at about 22%, okay, and the easiest way, by the way, to find out if you're not sure how to calculate this, remember, it's the total debt divided by the market cap. So if you go to Seeking Alpha, it's free website, but I do have subscription, but you don't need subscription to see this. If you scroll all the way down here where it talks about capital structure, okay, you've got the total debt here. If you divide this 7.86 by 34.78 and get times it by 100, you'll get about 22% or so. Okay, I think that's what you will get here. So you can easily do this. Okay, let's call it 22.5%. Okay, percent. So what I don't want is just the debt level to increase any further than it is, and if it does, then it will be a problem for us investors. So what am I doing with the company right now? I'm definitely going to hold on to it. I was hoping it will come back down a little bit, and hopefully from the next quarter I want to see that basically the company paying off that debt. if the debt level increases next quarter or the next basically report, whenever they report next one, then I might have to sell it. But for now, I'm comfortable. That 22% is fine. It's not too big. But if the market, comes back down again and the debt stays the same or even increases, then we are in trouble. So for that reason, I'm watching this company. I'm hoping that it will come back down so I can buy more. And I'm hoping that they will actually buy and start basically financing that debt. Okay. But again, if in terms of the business side of it, I'm really happy. In terms of growth, in terms of the financials, is great, but the debt level is the only concern I have about this business. So inshallah, we'll see what happens going forward. But for now, I'm really comfortable holding it. 22% is actually better than the 29% or so when it basically gets to that 33% threshold that we're looking for normally. Okay. But yeah, so overall, that's my thoughts of this company. It's a great company. I like the business model. I like how, in terms of the companies that they work with, the engines that develop, the technology they actually using to kind of innovate their product and so on is absolutely amazing. So I'm going to hold on to it. If it comes back down, I'll buy more of it. I'm hoping the debt will come back down. So, and that's my take on that business. Hopefully you enjoyed the video. If you have, please like the video, subscribe to the channel. Just to kind of give you an overall portfolio view right now. We were at the beginning of the week, let's see, yeah, £67,000, and right now we'll basically fee £65,271. And what is happening to the market is basically hasn't been a great week this week. Okay, I haven't added, I think I added £100 this week, so I still got a little bit more money to add today. So I will be buying more stocks today. I'm hoping that when the market opens today, it will go down a little bit, and some of the companies that I really want to add to it, hopefully will come back down a little bit. Anyway, that's my take on comments. I hope you enjoyed the video. Have a wonderful day. Assalamu Alaikum.